What's up? My name is Jack Murphy, and I recently made a big change to my dividend portfolio. I changed a lot of stuff recently, and this happened around the same time as that big August 5th dip. And by the time this video comes out, some of that new CPI data might be coming out. So I just want to let everyone know that it was independent of those. I was planning on making this change for the past 2 months, and it just happened to fall around this big volatile market. The market's going to be fine in the long run, so don't worry about these short-term spurts of volatility. This change was independent of those, so I want to make that clear. Another reason I made this change is because my portfolio was lacking growth. It was getting outperformed by the S&P 500 during the good months of the stock market, and I wanted to make my portfolio able to keep up with the S&P 500's growth while also having that protection with the dividends and the income from the dividends. So my dividend income is still a priority in the portfolio, but I am also trying to have a little more growth in the portfolio so I can take advantage of all these years I have to invest. So I'm going to talk about all the stocks I sold, why I sold them, all the stocks I bought and why I bought them, and then at the end I'm going to go over my new portfolio, all the data, all the statistics, the new dividend income, and all that good stuff. So stay around for the end for that. But first, I'm going to go over the positions I sold and why. So going over my first sells, I'm going to talk about the more obvious ones that some people have probably saw coming. VYM and VIG are both dividend ETFs that are pretty similar to SCHD, but in my opinion, just a little bit worse. So I just sold them and put that money into SCHD because I'd rather have less positions and more money in the probably better ETF. And I also sold JEPI, which is a covered call ETF, which I've reconsidered and I'm not much of a fan of anymore. And until I'm retirement age, there's no real reason for me to be holding it as a 19-year-old. Maybe in 40-something years, when I am retirement age, I will reconsider. But until then, the dividends are not outweighing the growth, so I did sell that position. The next position I sold was UGI. And it might not be a terrible stock, but I reconsidered. It may have good dividends, but the growth history has been so bad, I don't think it's going to keep up. So I decided to sell it. It may be a better investment for someone else, but I don't think it is good in my portfolio right now, so I sold it. Verizon actually had a pretty good year and did well in my portfolio, but looking back 10 years, it is still down and revenue is stagnant. This has good dividends and maybe a good hold for someone else, but in my opinion, for me, it is not a good position to be holding right now, so I decided to sell it. Moving on to probably the least controversial sell I'm going to talk about today, 3M. This company has been in my portfolio for 2 years and has been the biggest loser almost the entire time, but through dividends and the recent price movement upwards of 20-something% in the last month has brought it to a over break-even price for me, so I actually did make a little money off of 3M, and I was able to exit out profitable, but they've really just done pretty bad for the last decade, and they've had a lot of issues in the last few years, hurting their growth. They have pretty good dividends, but I just don't know if it's going to be a stronghold for at least the next decade. So I decided to exit out and move that money to better opportunities. I feel like those sells were all pretty obvious, and I think everyone will agree they were good decisions. But I have 3 more stocks that I would say are somewhat controversial for me to be selling. They're not bad, but I have reasons to sell them. So the first of the 3 more controversial stocks I'm selling is Target. Now, I don't think Target's a bad company, but I just think I have them covered in my portfolio already. So if we look at stocks like Johnson & Johnson, Procter & Gamble, and Pepsi, a lot of products in Target are made by these companies, so I feel like I'm covered in that part of the portfolio from those 3 stocks and don't really need Target. Target is just one of many stores like Walmart, Costco, and ShopRite, and many more. They're probably one of the more expensive ones, so they maybe wouldn't be getting the best business. If we were in some type of economic downturn, people might go to Walmart or Costco instead. So Target might not be the best thing to hold if I've already got the companies that own the products in Target. And on the retail side, if the economy is prospering and retail is doing really well, I also bought Amazon, and I think that part of the portfolio is covered. So I just don't think I need to be holding Target, and I wanted to trim down my positions, so I cut Target for that reason. And my second big sell was Apple. So Apple is not a bad company, but I just found a different technology company that I think is better, and that's Microsoft. There's really not a big red flag in Apple that's making me want to sell. I just have two technology stocks I want to own, and I want to own one more, and I don't want to have two technology stocks in this portfolio. So I'm moving that Apple money to Microsoft. And I'm up 40% on my Apple position, so I'm happy to sell it now. If the market is more volatile for the next few months, having both Apple and Microsoft, I think Microsoft will hold up a little better and do better long term. So that's just why I decided to cut my Apple position. And the final position I sold was AbbVie, and I know that's going to upset some dividend investors, but I have a good reason. I found a better biotech company for me, in my opinion. It's 1/3 the market cap, and I think it has a lot more growth potential. So I switched out my AbbVie position for Regeneron. Let's compare AbbVie to Regeneron. So first off, let's look at their drug sales. AbbVie is doing fine. Their best drug or their best selling product is going down in sales. They're not doing well, and this is hurting the company, but they're well diversified and have other products that they sell, and they're all doing well. So AbbVie is going to be fine, most likely, but if your best product isn't selling well, that does hurt you as a company. And if you look at Regeneron's earning, their top earner by a lot is this eye injection that helps with eye deterioration. I'm not a scientist, but about $6 billion in sales a year, and they're up a little bit this quarter, or the most recent earnings report, which isn't a lot, but they have a strong product that always does well for them, and that is a great thing to see. But if we look at their number 2 drug, is up 41% this quarter, and this is a type of skin cancer treatment for a type of skin cancer that gets like 5 million diagnoses a year, and it is semi-new, so it's showing a lot of good growth in sales, a lot of potential to be a very successful drug, so that is a good look for Regeneron. I'm actually going to compare Regeneron and AbbVie a little bit more to talk about why I made the switch. Now, I'm not a super nitpicky guy in the financial statements. I'm not going to find, the one factor in there that shows you what the next big company is, but there's a couple things that I like to see, and I'm going to show you them and compare them between AbbVie and Regeneron. So first off, if we look at their revenues, there's a general uptrend, which I like to see. And if we look at their revenues in the trailing 12 months, it's about almost $13 billion, and their cost of revenue, about $6 billion, which leaves a gross profit of around $7 billion, which looks good. And if we look in their balance sheet, a few things I like to look at are the total assets. So for Regeneron right now, that is about $36 billion. And then I like to look at total liabilities, only about $7 billion for total liabilities. Long-term debt, less than $2 billion. So with $36 billion in assets, I like that. Now let's look at AbbVie. General trend upward, but kind of stagnant for the last 4 years. Not much worse than Regeneron, but a little stagnant in the last couple years. And gross profit is about the same. If you look at their balance sheet, go over what I talked about before. The total assets, 141, or about actually 142 billion. Then total liabilities, about $135 billion. So not a big difference in between those assets and liabilities. I do like to see $58 billion of long-term debt. So that is not a good growth indicator in my opinion. So those are some of the reasons I sold AbbVie and like Regeneron a little bit better. But now we're going to move over into the positions I bought, and I'm going to talk about Regeneron first so we can go a little more in depth on that company. Like I said before, they have a pretty good lineup of drugs now, but what I'm most excited about for Regeneron is what they got cooking up in the lab. First off, they have more cancer research going on after the success of Libtayo, and because Libtayo is so successful, I am led to believe that their other cancer drugs that are in development are also going to be successful, so that's probably going to be good for the company in the future. And I don't want to downplay the cancer research, which is probably talked about more, but there's something less talked about from my research that I think is underrated, and that is a drug that will prevent muscle loss with the use of a weight loss drug like Ozempic. They talk about it briefly in their most recent earnings call, and they just talk about how using a weight loss drug like Ozempic leads to a lot of muscle loss. About 40% of the weight loss is muscle, and especially for older people, this muscle will be almost impossible or extremely difficult to get back and could be really bad for that person's health. So having a drug like this will be extremely helpful. They finished testing drugs on primates and were successful, and they're moving on to human trials, and those have started already, I'm pretty sure, considering how the timeline worked out. So they are already trying their human trials with this drug, and that will finish about a year out from now in August of 2025, I would guess. Here's a slide from one of the corporate presentations I got off their website, and it shows you the timeline for the human trials going on now. I'll have the earnings call and this presentation linked in the description if you want to read them yourself. That's where I got my information. Ozempic is already doing about $14 billion in sales a year, and if it partnered up with, or if it got paired up with this new Regeneron drug that could be potentially coming out in a year, the sales for both would do extremely well. Ozempic sales only at $14 billion right now would go up even higher because all the people not using it because of the muscle loss would probably start using it. If everyone wants to lose weight and not lose muscle, they got to use Regeneron's drug as well, so those sales will do really well. And I'm not quoting Regeneron, I didn't see this anywhere, but I can imagine a drug like this would have a lot of other use cases like physical therapy. It would be good for old people who lose muscle as they age. I don't know, there's just a lot of use cases for a muscle repairing drug. I could just see a lot of good stuff coming from a drug like this, so that I think that's really underrated for Regeneron, and I want to build a position now before that comes out because I think it'll do well. So I know this is a dividend portfolio, but Regeneron does not have any dividends at the moment. This is more of a growth play because I do want to have some more growth in the portfolio to help it keep up with the S&P 500 while also paying me dividends. So I am sacrificing my AbbVie dividends for Regeneron. So the next stock I bought was Microsoft, and Microsoft is the best tech company in my opinion for a dividend investor also because they have some dividends with some good dividend growth. That's not why I'm buying it. It's a good position to have some tech exposure, and they also have some AI exposure. So they're extremely well diversified, and they are investing a lot into AI, but if AI isn't as big as people are saying it'll survive and still do okay. So I want to go over some highlights from their earnings that I think looked good. Revenue year over year was up 15%, and Microsoft Cloud revenue was up 23% year over year. So good things to see, but that's not the biggest percentage increase. Microsoft's AI was up 60% year over year, and a lot of companies use that, and I think that's a good sign for Microsoft. Another thing Microsoft has going for them is Microsoft GitHub, a very popular AI development tool, one of the most popular, that is only about 2 years old, but already has 77,000 organizations using it, and the revenue from GitHub is up 180%. And those were just highlights from the earning report. That was actually very good, but obviously Microsoft has done pretty poorly stock price wise the past couple weeks, and that's probably due to CrowdStrike, or the security breach. Really wasn't their fault, it was CrowdStrike's fault, along with this whole Japan thing that affected the US stock market. Microsoft stock took a pretty big hit, so the value is lower and we're getting in at a better price. So even though the earnings report were very positive, the price went down, which is good for long-term buyers. Microsoft is one of the biggest leaders in the AI space, and they already have a vast network of customers to profit off of this. Also, something interesting, After I started my Microsoft position, and in between when I bought it and am filming this, Google got into some trouble with the law, and they are considered a monopoly for the search engine space. And this could actually benefit Microsoft because they have Bing, and they've been working for a while on making Bing like the top AI search network. Now that Google, I don't know what it will be, but they'll have some type of limitations or restrictions on them now. This could give Bing the opportunity to, do really well and become the top AI search engine. Speculative because, that just happened and that wasn't in my original analysis, but that could be another profitable side of Microsoft that will do well in the future. I also don't want to forget their dividend stats. They got about a 0.74% yield, which isn't a lot, but they're not really a dividend company. That being said, this is only off of a 25% payout ratio, which is pretty low, so that is good. And they have double-digit 5-year average dividend growth, so that is very good to see. And they have 19 years of dividend growth, which is pretty good to see. Only 6 years away from being a dividend aristocrat, which is good news if you are a dividend investor who wants some growth as well. The next stock added to the portfolio was Amazon. Amazon has been a staple of growth stocks for a long time, and this was another growth-focused position I added in my portfolio because it does not have any dividends. Amazon also was on a pretty good dip right now around this time in the market, so I decided to start a position in Amazon. I'm going to go over a few reasons why it is a good pick for me right now, and let's look at the financial statements first. So first we can look at the income statement and revenue. That general trend upwards I like to see, along with the gross income, so that's good to see. Most important things in my opinion are the total assets, which right now are about 550 billion, very good. And then we also have total liabilities, which is around 318 billion, which is a lot, but there is still over a $200 billion difference, so that is good enough for me. And then long-term debt is about 61, almost 62 billion, but that's less than 15% of their total assets. Not a significant number, but I'm just trying to put into perspective how 61 billion isn't that bad for a company as big as Amazon. Some other interesting valuations for Amazon is their price to cash flow. This is a good long-term indicator, and it is down considerably right now from the average. The average is around 27, 28, and it is under 17 right now, as you can see on this chart. So that does seem like a good time for a long-term investor to buy some Amazon. We can also look down and see their PE is still 32, almost 33. Considering the average is 68, almost 67, that is a considerable discount. These valuation metrics for long-term investors do make it seem like Amazon is a good buy now, which are factors that made me think it's a good buy for me. A lot of that fear of a potential economic downturn did get priced into Amazon during that recent dip, so that's why I started my position there, and I'm happy to dollar cost average it if the economy flourishes for the next year, or if we do go into recession, I'd be even happier to dollar cost average down into Amazon and get my position, juicy for the next decade, we'll say. The fourth new position I bought was Chevron. This is the second largest oil company and a very popular dividend stock. Now I wanted to add some more dividend stocks because I cut a lot of them, and that is the bread and butter of this portfolio. So I'm going to talk about some of their dividend stats now. They have a very impressive 4.5% yield off of a 52% payout ratio, which is a little high, but it's under 60%, which is usually the area I would get concerned. And they only have about a 6% 5-year average growth rate, but considering the dividend yield is already so high, it's understandable that the growth rate is a little slower. Let's also look at some of the important metrics in the financial statements that I like to look at. Revenue. So obviously it's not a linear growth, but that's just because oil is, such a seasonal commodity, and, the price fluctuates, and it's already an established business, so it's not going to have crazy linear growth, which is why I'm kind of okay, ignoring that requirement or preference when looking at this balance sheet. Same goes with the gross profit. Now let's look at the balance sheet. The total assets are about 260 billion and total liabilities only about 100 billion. So a good 160 billion in between, and only 21 million of that is long-term debt. So I don't think that's going to be much of an issue. They also have been growing their dividends for 36 years, which makes them a dividend aristocrat and only 14 years away from being a dividend king. I think around 145 is a good buy price for Chevron, and I'm not really concerned dollar cost averaging into it, until like $175. So I do think it is a good time to start a position. And the last new position I bought in my portfolio is Visa. To give it a shout out to Ryan Williams for putting this on my radar, because it seems like a really high quality dividend company. So before I talk about their dividend stats, let's look at some of those key indicators of the financial statements I like to see. Revenue, pretty linear growth. There's a little hiccup in 2020, and that is because of, COVID, economic, downfall, had less transactions going on, so completely understandable. Balance sheet, want to look at their total assets, about 91 billion, and total liabilities, 51 billion. Probably the worst spread I've seen out of my new positions, but only 20 billion is in long-term debt, and there's still a $40 billion difference between total liabilities and total assets, so not a big red flag for me. But probably my favorite part of Visa is their dividend stats. Aside from the yield, which is a little low at 0.8%, they have only a 21% payout ratio, so they're not spending too much money to keep up this dividend, which is a good sign. And they also have a 5-year growth rate of 15.77%. Plus, they also got 15 years of dividend growth. Not quite a dividend aristocrat, but still pretty good numbers. So those are all the stocks I bought and sold during this recomposition of my portfolio. And here's a list of the 5 new stocks I bought and my average cost per share as of now. So there's that. And then here is all the stocks I also bought that I already owned, but just added to during this last week, and the new average cost per share. Now, let's look at my new portfolio. I'm on Snowball Analytics right now, and we'll go over and check out my holdings. So there's Amazon, Chevron, Johnson & Johnson, JP Morgan, Lowe's, Main Street Capital, Altair Group, Microsoft, Realty Income, Pepsi, Procter & Gamble, Regeneron, Starbucks, SCHD, Texas Roadhouse, and Visa. Here is a breakdown of my portfolio in a pie chart that looks pretty good. I'm not going to read out all the percentages, but you can pause and look if you want. I think it's pretty well diversified aside from the cash position that's in the portfolio right now, a little bit high, so definitely going to lower that as I keep buying more stocks. We can work on evening those out a little bit, but I'm pretty happy with that right now. Now, how were the dividends affected? Obviously, I sold a lot of dividend stocks, and a lot of the stocks I bought didn't have dividends or had low yields. So what are my dividends looking like right now? And my new yield is 3.27%. So still pretty good in my opinion. Anything over 3 I'm fine with. And my new annual dividends, so what am I going to get paid for 12 months, is $228-ish. This is coming from $279, basically $280. So I did lose about $50 in yearly dividends, but I think this was a good change to the portfolio overall. I'm okay with losing a little progress on my dividends, but probably putting myself in a better long-term position. I also want to go over to Seeking Alpha and look at my health score. So I have my portfolio in Seeking Alpha, and it can give you scores of its opinion on your stocks. How healthy is my portfolio? It says I'm at a 3.65, which is in the green range. And then how I compare. Apparently my portfolio is in the top 19% of all portfolios, at least on Seeking Alpha. So I'm pretty happy with that. What do analysts think? I'm at about a 3.7, which is also in the green. No stocks in the sell territory, which is good to see. My dividend safety score is a 3.13, which is in that yellow range, which I maybe disagree with. I think I'm a little higher than that. Some of the strengths and weaknesses of my portfolio. Profitability is an A, which probably makes sense for dividend investors. Momentum is a B minus. Earnings per share revenue is a C plus. Growth is a C, and valuation is a C minus. I do have some high value companies in my portfolio, so that probably hurts the valuation. And then once again, a lot of high value companies, less growth potential, which is what I tried to, add more of through this recomposition, but I can still understand it being a C. And then momentum, that's just how the stocks have been doing lately. B minus I think is fair. Earnings per share revisions, no opinion, I guess C plus is fine. I actually want to head back to Snowball Analytics for one more thing, and I want to backtest my new portfolio. So what I'm going to do is go and backtest it, and here is the allocations by sector. Because cash right now is at 11%, and I don't think it's ever been that high before, I'm going to bring it back down to a more realistic 3% and add 1% more to each sector. So that's technically not my portfolio right now, but I never had 11% cash before, and that's just because the reallocation I did right now. So I'm going to just say 3% cash and spread it out evenly. So now we'll go down and back test it. Initial amount, I'll say 7,800 because that's where my portfolio is at right now. Start date, I'm going to have to put November 2011 because the youngest stock in my portfolio is SCHD, the ETF, and it was made in November 2011. So that's as far back as I can backtest. Contributions, I'm going to do $200 a month because that's what I do now. Hopefully in the next 13 years I increase that, but we'll just say that for now. And then dividend tax rate, I'm just going to say 6%. Reinvest dividends, yes. Rebalance, never. Calculate. So this would have my portfolio up about 21.5% or $8,000. Final balance, 126 grand and change. Total profit, 88 grand. Capital gains about $70,000. Dividends about $18,500. Dividends received, 17 grand. IRR, 15%. Volatility / beta is 0.82. So managed to have a lower than 1 beta while also outperforming the S&P 500. Cash balance is 2,800. So I don't even think I would have that much cash if my portfolio was worth over 100 grand, but I don't really know. And then if we look in that time, we're up 118 grand, and the S&P 500 would be up 110 grand. Obviously, a backtest isn't going to predict the future outcome, but it is good to know that my new portfolio historically has done well. So that's pretty much everything I wanted to say. That is my new portfolio. I think it is a change for the better. Let me know what you think in the comments. But besides that, thank you for watching. Peace.